Have you ever noticed how when the stock market crashes, some people panic while others start buying? When everyone else sees disaster, they see a sale. When the headlines scream danger, they see opportunity. When the world says run away, they lean in. Here's what nobody tells you about wealthy people. They're not seeing different facts than you are. They're not accessing secret information. They're just looking at the exact same situation through a completely different lens. And that lens makes all the difference between building wealth and staying broke. Here at Simple Money, we've spent years studying how successful investors think differently from everyone else. And we've discovered something fascinating. Rich people don't see less risk. They see risk differently. Today, I'm going to reveal how the wealthy have trained themselves to spot opportunity in the exact moments when everyone else is running for the exits. Here's what's really happening when you see risk and someone else sees opportunity. You're both looking at uncertainty, but you're asking different questions about it. Most people ask, what could I lose? Wealthy people ask, what could I gain? And what's the actual probability of loss? Those sound similar, but they're completely different questions that lead to completely different decisions. One question triggers fear and paralysis. The other triggers analysis and potential action. One keeps you safe and poor. The other creates wealth. Think about it this way. Imagine you're walking through a dark forest at night. Most people focus on all the dangers. Bears, cliffs, getting lost. Their brain is in threat detection mode. Every sound is a potential predator. Every shadow is a hazard. They're so focused on what could hurt them that they move slowly, cautiously. Or they don't move at all. But someone who knows the forest well, they're still aware of the dangers, but they're also noticing opportunities. The path that leads to safety, the clearing up ahead, the landmarks that show they're going the right direction. Same forest, same darkness, completely different experience based on how they're processing the information. This is exactly what happens in financial markets. In business, in investing, everyone sees the same data, the same headlines, the same price movements. But rich people have trained themselves to process that information differently. To see patterns instead of chaos, to see probability instead of just danger. Let me introduce you to what I call the loss focus trap. This is the first way that most people sabotage their own wealth building. The loss focus trap is when your brain gets so fixated on what you might lose that you can't evaluate what you might gain. Here's what I mean. The stock market drops 20%. Your brain immediately goes to worst case scenario. What if it drops another 20%? What if I lose everything? What if this is the beginning of a total collapse? You're so focused on potential losses that you can't see anything else. Meanwhile, someone wealthy looks at that same 20% drop and thinks differently. They think, okay, good companies are now 20% cheaper than they were last month. If I believe these companies will still exist and be valuable in 10 years, then this is literally a sale on future wealth. They're seeing the same drop, but they're focused on the opportunity, not just the danger. This isn't about being reckless or ignoring risk. It's about evaluating risk properly. Most people treat all uncertainty as pure threat. Rich people understand that uncertainty creates opportunities for those who can think clearly while others panic. Here's the uncomfortable truth. Your brain is wired to protect you from loss more than it's wired to seek gain. This is called loss aversion. Psychologists have studied this extensively. The pain of losing $100 feels about twice as intense as the pleasure of gaining $100. Your brain is literally weighted toward avoiding loss over seeking gain. This kept your ancestors alive. The person who was terrified of potential danger survived longer than the person who was too optimistic. But in the modern financial world, this same instinct keeps you poor. Because opportunities almost always come wrapped in uncertainty. And uncertainty triggers your loss aversion. So you avoid the opportunity to avoid the discomfort. Rich people have learned to override this instinct, not by being fearless, but by being analytical, by asking better questions, by focusing on probability and expected value instead of worst-case scenarios. They've trained themselves to see past their instinctive fear response. The second way wealthy people see differently is through what I call asymmetric thinking. This one is particularly powerful once you understand it. Asymmetric thinking is when you look for situations where the potential upside is much larger than the potential downside. Here's what this looks like in practice. Most people evaluate opportunities based on probability alone. They ask, what are the chances this works? If it seems risky, if the probability isn't super high, they pass. They need certainty, or near certainty, before they'll take action. But wealthy people look at the entire equation. They ask, what are the chances this works? What do I gain if it does? And what do I lose if it doesn't? They're looking for asymmetry. Situations where you risk a little to potentially gain a lot, where the downside is limited and the upside is massive. Let me give you a concrete example. Someone offers you an investment opportunity. There's a 50% chance it fails completely, and you lose your entire $10,000 investment. But there's a 50% chance it succeeds, and your $10,000 becomes $100,000. Most people hear 50% chance of failure and immediately say no. That sounds way too risky. 50-50 odds of losing everything? No thanks. They're focused on the probability and the potential loss. They're trapped in loss-focused trap thinking. But look at the math from an asymmetric perspective. 50% chance of losing $10,000. 50% chance of gaining $90,000. The expected value of this opportunity is positive $40,000. If you could make this bet 100 times, you'd end up massively ahead. The potential gain is 9 times larger than the potential loss. Now, I'm not saying you should take every bet with positive expected value. You need to be able to afford the loss. You need to diversify. You need to understand what you're investing in. But the point is that wealthy people are trained to see these asymmetric opportunities, to recognize when the potential upside dramatically outweighs the downside. And most people never even do this math because they stop at 50% chance of failure. This is why rich people invest in startups, real estate, and markets that seem risky to others. They're not blind to the risk. They've just evaluated the asymmetry. They've determined that the potential gains are worth the potential losses given the probabilities involved. They're playing a different game with different math. Now, here's where things get really interesting. The third difference is what I call timeline arbitrage. This might blow your mind because it's about seeing opportunity in time itself. Timeline arbitrage is when you recognize that something looks risky short-term but is actually quite safe long-term. Most people evaluate risk based on short-term volatility. If something goes up and down a lot, they perceive it as risky. If the value fluctuates, if there are scary moments, if things look bad temporarily, they categorize it as dangerous and stay away. But wealthy people understand that short-term volatility and long-term risk are completely different things. Something can be very volatile in the short term while being very safe in the long term, and that disconnect creates opportunity. The stock market is the perfect example of this. In any given day, the market might be up 2% or down 2%. In any given year, it might be up 30% or down 20%. That volatility scares people. It feels risky. It feels unpredictable. It feels dangerous. But zoom out. Look at any 20-year period in stock market history. The trajectory is up. Consistently. Powerfully. Yes, there are crashes along the way. But someone who stayed invested through those crashes ended up with dramatically more wealth than someone who stayed in cash to avoid the volatility. The person who sees short-term volatility as risk avoids the market. The person who understands timeline arbitrage sees that volatility as the price of admission for long-term gains. Same market, same data, completely different interpretation based on time frame. This is why wealthy people can stay calm during market crashes. They're not thinking about their portfolio value today. They're thinking about their portfolio value in 20 years. The crash isn't a disaster. It's a temporary dip in a long-term upward trajectory. It might even be an opportunity to buy more at lower prices. Meanwhile, most people are freaking out because they're focused on the short-term loss. They sell at the bottom because the volatility feels intolerable. They turn temporary paper losses into permanent real losses because they can't see past the immediate discomfort. The fourth way rich people see differently is through what I call the control analysis. This one is subtle, but incredibly powerful. Control analysis is when you separate risks you can control from risks you can't and focus your energy accordingly. Here's what most people do. They worry about everything. Market crashes, economic recessions, political changes, company failures, industry disruptions. They see all of these as reasons not to invest, not to take chances, not to pursue opportunities. They're overwhelmed by all the things that could go wrong. But here's what wealthy people do. They identify which risks they can actually influence or control, and which ones they can't. Then they take action on the controllable ones, and accept the uncontrollable ones as the cost of participating in wealth creation. Can you control whether the overall market goes up or down this year? No, but you can control your asset allocation, your diversification, your time frame, your contribution consistency. You can control whether you panic sell or stay the course. You can control your financial education and decision-making process. Can you control whether your individual business succeeds? Not completely, but you can control your effort, your strategy, your learning, your adaptability. You can control how you respond to setbacks. You can control whether you quit or persist. Rich people don't avoid risk. They manage the risks they can control and accept the risks they can't as part of the game. They don't wait for a world with no uncertainty. They build systems and strategies that work despite uncertainty. They focus their energy on the variables they can influence, instead of worrying about the ones they can't. This is why wealthy people seem so calm about things that terrify everyone else. They're not less aware of the risks, they've just categorized them differently. They know which risks deserve their attention and action, and which ones are just background noise they need to accept to play the wealth-building game. The fifth way rich people see opportunity differently is what I call crowd-contrary thinking. This one might be the most counterintuitive of all. Crowd-contrary thinking is when you recognize that maximum fear often indicates maximum opportunity, and maximum excitement often indicates maximum risk. Here's the thing about crowds. They're almost always wrong at extremes. When everyone is terrified, when the news is all doom and gloom, when people are selling everything and running for safety, that's usually the best time to buy. When everyone is euphoric, when the news is all celebration, when people are buying everything without thought, that's usually the time to be cautious. Why? Because asset prices reflect collective psychology. When everyone is scared, prices get driven down below their actual value. When everyone is greedy, prices get driven up above their actual value. The opportunity is in the disconnect between price and value, and that disconnect is largest when emotions are most extreme. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This isn't just a cute saying, it's a description of how wealthy people actually think. They've trained themselves to recognize that their best opportunities often come when their instincts are screaming at them to run away. Think about the 2008 financial crisis. The housing market collapsed. The stock market crashed. Banks were failing. Everyone was terrified. The overwhelming consensus was that everything was falling apart. Most people sold their investments, stayed in cash, waited for safety, but some people looked at the exact same situation and saw opportunity. Houses were selling for half their previous value. Good companies were trading at ridiculous discounts. Everything was on sale. It felt terrifying, but the math showed incredible potential returns for anyone brave enough to buy when blood was in the streets. The people who bought during that panic made fortunes. The people who sold or stayed in cash missed out on one of the greatest wealth-building opportunities in modern history. Same crisis, same information, completely different outcomes based on how they processed the collective fear. But here's what nobody wants to admit. This is really hard to do. Every instinct in your body is telling you to follow the crowd, to seek safety when everyone else is seeking safety, to get excited when everyone else is excited. Going against the crowd feels wrong, dangerous, stupid even. This is why most people never build significant wealth. They can't override their instinct to follow the herd. They can't make themselves buy when it feels scariest, or hold back when it feels safest. They're trapped in the same emotional cycles as everyone else. And those cycles systematically transfer wealth from the many to the few who can think independently. Let me tell you about two people who experienced the exact same market crash. We'll call them Lisa and Tom. Both had about $80,000 invested when the market dropped 35%, seemingly overnight. Both watched their accounts shrink to about $52,000. Both felt sick about it. Lisa's immediate reaction is panic. She's lost $28,000. Her brain is screaming danger. She reads articles predicting the market will drop another 30%. She hears people saying this could be the beginning of another Great Depression. She watches the news showing chaos and fear. Every signal she's receiving says get out now before you lose everything. So Lisa sells. All of it. She moves everything to cash. She feels relieved at first. At least she stopped the bleeding. At least she protected the $52,000 she has left. She tells herself she'll get back in when things stabilize, when it's safer, when the coast is clear. But here's what happens. The market keeps dropping for a few more weeks. Lisa feels smart. She avoided those losses. Then the market starts recovering, slowly at first. Lisa is still scared, still waiting for the right time. The market keeps climbing. Lisa keeps waiting. She's waiting for a pullback, for another chance to get in at a good price, for things to feel safe. Years pass. The market has fully recovered, and then some. Lisa's $52,000 is still sitting in cash. Still $52,000. Maybe $55,000 with interest. Meanwhile, if she'd just stayed invested, that money would be back to $80,000 and climbing. She locked in her losses, missed the recovery, and now feels like she can't get back in because prices are so high. Lisa is furious at herself, confused. She was trying to be smart, trying to protect herself. She made what felt like the reasonable, safe decision. How did it turn out so wrong? Now let's talk about Tom. Tom watches his $80,000 drop to $52,000. He feels exactly the same fear Lisa does. His instinct is screaming at him to sell, to get out, to protect what's left. Every article he reads is terrifying. Every conversation he has is full of doom predictions. But Tom has trained himself to think differently. He asks himself different questions. He asks, do I still believe these companies will exist and be profitable in 10 years? Yes. He asks, is anything fundamentally different about these businesses, or are they just cheaper? Just cheaper. He asks, historically, what happens to people who sell during crashes versus people who stay invested? The people who stay invested recover and prosper. The people who sell lock in losses and miss recoveries. So Tom does something that feels completely insane. He doesn't just hold his investments, he adds to them. He takes $5,000 from his emergency fund, money he was saving for a rainy day, and he invests it, buys more of the same funds he already owns, now at 35% discount. Tom feels terrified doing this. Every instinct says this is stupid. This is reckless. You're throwing good money after bad. But he's trained himself to recognize that this feeling, this terror, while everyone else is terrified, this is often the signal of opportunity. Not certainty, but probability tilted in his favor. The market keeps dropping for a few weeks. Tom's investment shrinks even more. He questions his decision. Maybe Lisa was right to sell, but he holds. Then the market starts recovering, slowly at first, then faster. Within 2 years, Tom's original $80,000 is back to $80,000, but his $5,000 investment during the crash? It's worth over $7,000. He made money from the crash. Within 5 years, his total investment is worth over $120,000. He didn't just recover, he profited. The exact same crash that caused Lisa to lock in permanent losses created wealth for Tom. Same event, same information, completely different outcome. Here's what most people don't realize. The difference between Lisa and Tom isn't about courage or risk tolerance or lucky timing. It's about how they processed the exact same information. Lisa saw risk and reacted with fear. Tom saw risk and analyzed it. Lisa followed the crowd into panic. Tom recognized crowd panic as a contrarian signal. Lisa made decisions based on how things felt. Tom made decisions based on historical patterns and probability. It's not actually about taking more risk or being braver. It's about seeing risk differently, understanding that what feels risky often isn't, and what feels safe often is. Recognizing that your instincts, while useful for physical survival, are terrible for financial decisions. Learning to override emotional reactions with analytical thinking. The wealthy don't see different opportunities than you do. They see the same situations through a different lens. They've trained themselves to ask different questions, to focus on different variables, to think in time frames that extend past immediate discomfort, to separate controllable from uncontrollable, to recognize when crowd behavior creates inefficiencies they can exploit. The loss focus trap, asymmetric thinking, timeline arbitrage, control analysis, and crowd-contrary thinking. These aren't innate talents. They're not personality traits you're born with or without. They're learned patterns of thought, skills that can be developed, frameworks that can be adopted. The question isn't whether you can learn to see opportunity where others see risk. The question is whether you're willing to challenge your instincts, to think differently than the crowd, to train yourself to ask better questions when fear or excitement tries to drive your decisions, to recognize that feeling scared might actually be a signal you're looking at something valuable, not something dangerous. Because here's the truth that nobody wants to admit. The biggest opportunities in wealth building almost always come disguised as risk. They come when things feel uncertain, when the path forward isn't clear, when most people are running away. That discomfort, that fear, that uncertainty isn't a warning to avoid the opportunity. It's often the price of admission. And once you understand that, once you see that rich people aren't fearless or lucky or accessing secret information, they've just learned to process the same information differently, you can't unsee it. The whole game changes. Because you realize that what stands between you and wealth isn't external. It's not the market or the economy or your circumstances. It's the lens through which you see opportunity and risk. And that lens can be changed.